Hello everyone, in this video we will be doing the chapter 11 receivables of ACCA F3 financial accounting. So before watching this video, make sure that you watch the previous chapters, and if you haven't, I have linked the playlist in the description box below. In case you would like to solve the Kaplan exam kit, even the playlist for the same is given in the description box below. So the rules remain the same. Before starting this video, make sure that you have a paper, you have a calculator and a pen. If you will not write whatever you're learning, then there is no point of watching this video. So this is one of the easiest chapter. I believe that this is the simplest chapters in the book. So let's get started. We will be finishing it in one part video only because it's a very easy chapter and a basic one which we already know. So receivables. Let's talk about that. What are receivables? So receivable is something which we ought to receive, something we are supposed to receive. So we have discussed in the previous chapter that receivables are an asset and payables are a liability. We know that also, that receivables are my asset. And what is the balance of asset? Asset balance is always debit. This also we know. So receivables are something somebody else has to pay to us. So it is their liability. So it is something I am supposed to receive. So it is an asset to my business. So that is what receivables are. So when I make a sales, if my business has a sales and I get cash in return, what is the journal entry? By now we know that it is debit cash and credit sales. Why? Because we are going to receive the cash. And whenever I make a credit sale, what is the journal entry? Debit receivables and credit sales. So you know that receivables have a debit balance. Okay, so trade receivables. So there are two things here. So we are going to speak about what irrecoverable debts are and what allowance of receivables are. So if you can recall what irrecoverable debts are, it is nothing but bad debts. So you know what bad debts are. We have seen this also in the previous chapters. So what are bad debts? When someone owes us money, but they will not pay the money now. So that is a loss to the business, right? So if you think about it, let's say we have receivables. We have a company X. So the company X took a credit sale from us. So we made a credit sales with the company X of, let's say, $10,000. And it's a credit sale, so they will probably pay us after a while, right? Now the company X became insolvent. Okay, so the company X became insolvent. What is insolvency? Insolvency is nothing but bankrupt. So the company X is now bankrupt, which means we know that they will not be repaying us. They will not be paying for the credit sales which they have availed because they have become insolvent now, right? In such a situation, are we going to get our $10,000 back? No, we will not be getting our $10,000 back, which means that this is a bad debt. So what does bad debt mean? Bad debt means that the company, for various reasons like insolvency, bankruptcy, whatever the reason is, the company is not going to pay us anymore, which means that this is in a way a loss to the business because we have given our services, we have given our products, but now we are not receiving the money for the same. So these are nothing but bad debts. Now another word for bad debts is irrecoverable debts. What does irrecoverable debts mean? We cannot recover the debt anymore. They are not going to pay us anymore. So it is a debt which they cannot recover. We cannot recover anymore. We will not be getting the debts back. So that is why we call it irrecoverable debts. So now irrecoverable debts. Okay. Now, what do you understand by allowance for receivables? Now, let me show you that also. So, let us talk about what allowance for receivables are. Okay, so every year a business assumes that this much bad debt will occur in the year, or let's say I can assume that if I have a receivables of, let's say, 10 lakhs, I know that every year, by the end of the year, some receivables are going to become irrecoverable because some or the other company might become insolvent or someone can just run away. Anything can happen. I am sure that 50,000 every year are going to be my bad debts. So last year also I had 50,000 irrecoverable debts. The last to last year also I had 50,000. So because of my historical, situations, I know that every year minimum or at least this much bad debt situation occurs. So in such a situation, what can I do? I can create a provision, right? I can create a provision or I can create an allowance. I can keep some money aside with me and I can just be like, I can keep the amount aside. Like, I am assuming this much of irrecoverable debt to happen. So, in such a situation, I will already be having a reserve. I will already be having a provision or an allowance, right? So, that is what they're talking about. Keeping aside some money, whenever such a situation arises, I can basically use it. So I hope it's clear now what allowance means. Allowance is provision. Provision means we are anticipating a particular situation to occur in the future. So, to be prepared for such a situation, we are already setting some money aside. So, we are anticipating that a particular amount of irrecoverable debt situation might arise in the future. So, to handle that situation, we are setting aside an allowance, so which is nothing but allowance for irrecoverable debts, allowance for receivables. And now you all know that provision for receivables is always a liability because the balance of provisions is credit. So that is what allowance for receivable is and irrecoverable debts is. So this is the journal entry of a cash sales. We know what the journal entry of a cash sales is. Debit cash to credit sales. We have discussed that. And we know what the credit entry journal entry is. Receivables to sales. And when this is the situation, right? Receivables to sales. So after some days, when the when the person pays his amount which was due, then what happens? Then cash comes in and the receivable account closes. So this also we know. This is when his debt gets settled. Okay, so let's read this. The provision of credit facilities. So, what is the provision of credit facilities? The majority of businesses will sell to their customer on credit and state a defined time within which they must pay. So, what is a credit period? A credit period is when it is assumed that by this time the person has to pay back the credit which was taken. So, that is what is known as a credit period. So if I am making an invoice and I want the person to pay us back within the next, let's say, 2 months, then the credit period would be 2 months. So that is what is known as the credit period. Now let's see what the benefits are. So the business may be able to enter new markets. So the business would be able to enter new markets. Why? Because when we are setting a credit period, then that would allow many people to avail services from us, right? If we do not have a credit sale policy, then many of the people will not buy from us. Then there is a possibility of increased sales, obviously. So if a person knows that when I buy from this business they can give me stuff on credit, then obviously more and more people will buy, right? Customer loyalty may be encouraged. So whenever we make sales and if a repeated person, you know, conducts a business transaction with us, then loyalty also gets increased. The person would come to us and buy from us more often. Costs can be costly. Okay, so this can be costly. Credit sales might be costly because that is basically, it can be costly to us, right? And there is a lost interest. What do you mean by lost interest? If I made a credit sale with to someone for, let's say, 1 lakh, and they will be giving the money after a year, if I would have kept the 1 lakh in the bank, then I would have, received interest on the same. So there is a loss of interest. Cash flow may deteriorate. Okay, cash flow may deteriorate. Why am I saying that? So there will be less cash in the business because something which was out to receive hasn't been received yet. There is a potential risk of irrecoverable debts. Only when you sell something on credit, only then there is a chance of having bad debts. If I do not sell something on credit, then bad debts or irrecoverable debts will not occur only. That is what they're trying to explain. What is aged receivables analysis? So aged receivable analysis is basically very, very, very easy. Let's say there was this person A. Okay, before explaining this, first take a moment to read this. Take a moment to read the aged receivables analysis and the credit limits, then I will discuss the same with you all. What exactly is aged receivables analysis? Let's talk about that. Aged receivables analysis. So what is aged receivables analysis? So let's say we have various people and we have various debtors, okay? And we have various debtors. Somebody X in 2015 December has to pay 1500. Y had to pay 2016 Jan. Okay, and Z. So what are we gonna do? Who are we going to ask for the money first? The person who took it on credit in 2015 is expected to pay us first. We will first go and tell the 2015 person that, hey, look, you took stuff on credit from me in 2015 and you haven't paid me yet, it's 2018. You will first go to him because this is the oldest debtor. Then you will ask Y 2016, then Z 2017. So the oldest creditor will always be asked first. So you are going to do the aged receivables analysis. The business is going to do an analysis as to who is the oldest debtor, and they will go and ask the oldest debtor to get the and repay the debt first. So that is what is known as aged receivables analysis. Let's read it out. Where credit facilities are offered, it is normal for a business to maintain an aged receivables analysis. Analysis is usually a list ordered by name showing how much each customer owes and how old their debts are. The credit control function of a business uses the analysis to keep track of the outstanding debts and follow up. So we are going to call and follow up. We're going to say that, hey, you got to pay, Timely collection of debts improves cash flow and reduces the risk. So it, betters the cash flow, because if money comes in, the cash flow gets better. And if we keep following up, then the situation of bad debts arising will be reduced. Credit limit. Okay, keep in mind, bad debts and irrecoverable debts are one and the same thing. Credit limits. We know what credit limits are. What is credit limits? So if X wants to buy something on credit, I will allow only up to 10,000. If Y is a new person, Y never bought stuff from me, Y is my new customer, so I can't trust a new customer so easily. So I will give him only 5,000 on credit. Now I have Z. Z is my frequent customer, so I trust Z. Z has taken stuff on credit many times and he has always repaid. So I trust Z, which means to Z, I will give him 50,000. So that is what is known as credit limit. Based on the historical performance, we can see that how much credit are we, interested to welcome, are we interested to extend to the people. It is normal for a business to set a credit limit for each customer. This is maximum amount of credit that each business is willing to provide. The use of credit limit reduce the risk to business of irrecoverable debts by limiting the amount sold on credit. Help build up the trust of a new customer. Be part of the credit control strategy of the business. Now, we already discussed what irrecoverable debts are and we also discovered what the allowances are. Let's just read it now. The accruals concept dictates that when a sale is made, it is recognized in the accounts regardless of whether or not cash has been received. Occasionally, customers either refuse to pay or cannot settle their outstanding debts. Not only does this lead to a loss of cash income for a business, it also means that it may have an asset in its statement of financial position that is unlikely to be able to collect. So, did you understand what they're saying? So, you all remember what the accrual concept is. As in when you receive a thing, be it should belong to this year, that will be recorded. That is what was our accrual concept, right? And that is what they're also saying. If it is highly unlikely that the amount owed by a customer will be received, then this debt is known as an irrecoverable debt. So, if we are sure that someone will not be paying us anymore, we know that this money will not come back to us, then that time it becomes an irrecoverable debt. Irrecoverable debt are written off by removing them from the ledger accounts completely. This course of action would be necessary if a customer was in formal liquidation proceedings and it was known that the outstanding debt will not be recovered. So, as we have discussed earlier, if we know that someone will not get the money, it becomes our irrecoverable debt. But if we are 100% sure that someone will not be giving us, why? Due to the bankruptcy, illiquidacy, solvency, whatever the reason is, that means we know that 100% we will not be getting the money. In such a situation, we write off the bad debts, we write off the irrecoverable debts because now we are 100% sure that we will not be getting the money. If there is concern over whether a customer will pay, but there is still hope that the amount can be recovered and allowances created. So when we are sure that someone will not pay in that time we write it off. But if we feel like maybe they might pay, if we have a little bit of hope left, that time we create an allowance. Unlike an irrecoverable debt, these items are left in the receivables ledger but separate and opposite accounts. Don't worry, we will discuss this right now. So now let's come to the accounting treatment of the irrecoverable debt. So as I told you, irrecoverable debt is a loss to the business. Irrecoverable debts are an expense to the business. And what is the balance of expenses? All the expenses and losses are always debited. We know that. So usually the entry would, if we would have received the cash, the entry would have been debit cash and credit receivables. That would be the original entry, right? But in this situation, we are going to close the receivables account. We are crediting, but an expense has took place. So that would be irrecoverable debt expense. Why? Because irrecoverable debt expense will become my expense here. So it is going to be a loss to the business. So that will be debited and receivables would be credited. Let's start with the test to understanding 1. Arif and company has total accounts, just a second, total accounts receivable at the end of its accounting period of 45,000. One of these items, it is discovered that one, Mr. Zion, who owes us 790, has been declared bankrupt and another who gave his name Mr. Jones has totally disappeared, owing 1240. Calculate the effect on the financial statements. So, what will be the journal entries of the same? Think about it. How much receivables we had? Initially, we had 45,000. So, someone who was owing us 790 is bankrupt. So, what will be the journal entry of the same? Debit irrecoverable debt expense and credit receivables. Right. By how much will be 790? 790. Right? So this would be the journal entry. You understood how we did that? Mr. Jones has totally disappeared, owing a rough 1240. Okay. So Zion. Again, what will we do? Debit irrecoverable debt expense and credit receivables by Zion. How much? 1240. 1240. I hope you're writing it. So I hope you understood the journal entries. That is how we write off a bad debt. How do we write off an irrecoverable debt expense? This is how we write them off. Debit the expense, credit the receivables. Debit the irrecoverable debt expense, which is like written off, so credit the receivables. Okay. Now, what do you understand by irrecoverable debts recovered? So what happens is sometimes we write off the irrecoverable debts because we think that we are sure that we will never be receiving the money. So we write them off. Let's say X became bankrupt. So we assume that we will never get the money back. So we wrote him off. So by writing the receivables off, how did we do that? Debit irrecoverable debt expense and credit receivables. Now, after 3 years, the X who was bankrupt, X comes and now he messages us, he reaches out to us and he's like, I was bankrupt 3 years back, but now I am back and now my business is normal again and now we are all right. So now I would like to pay you back for the things you have given on credit 3 years ago. So after 3 years, this guy comes to us and he wants to pay us. So we will take that. But what happens? We get the money back, but we have already written off the debt he had with us. 3 years ago, when this happened, we thought we will never receive it back and we wrote it off. Now he is giving us the cash. So what entry do you do then? So irrecoverable debt expense is written off. So what would be the written off entry? So what would be the written off entry? Debit irrecoverable debts expense and credit receivables. We know that. And what would be the normal entry whenever cash is received before writing off? Cash is coming in and credit receivables. This is what is our normal entry. Okay. Now tell me, whenever an irrecoverable debt is recovered, so we have already closed the accounts, we have already written it off, now suddenly they are giving us the money. So in such situations, what are you gonna do? Think about it. Whenever irrecoverable debt is recovered, we are going to do debit cash. Why debit cash? Because cash comes in and credit the irrecoverable debt expense. So when you wrote off the irrecoverable debt, you are going to open it again and get the cash. Got it? Sometimes people keep a separate account which is irrecoverable debt recovered, but mostly people open the irrecoverable debt expense account again and show it. So did you get it? Let's quickly revise all the journal entries which we have been seeing so far. And I hope you write this down. Okay. What happens whenever there is a cash sales? This is your entry. Whenever there is a credit sales, what happens? receivables to sales, right? Debtor becomes bankrupt. This is also known as irrecoverable debts. What happens in such a situation? Whenever an irrecoverable debt situation occurs, what happens? Debit irrecoverable debts. So, whenever a situation of irrecoverable debt happens, what do? You are going to debit the irrecoverable debts. Why? Because it is an expense and the balance of expense are debit, and we are going to credit the receivables. So, what is this called? This is also called as writing off the receivables. So, why do we do this? We do this to write off the receivables so that the receivable account closes. Right? You got this? Now tell me. Let us assume here that credit sales this happen. After few days, the person before getting the bankrupt normally pays back. What happens? If a credit sale takes place and normally he pays the cash as and when. So we get debit cash and we get credit receivables. That's the normal entry we do. That's how we close the account. But when does a person become when does a debt becomes irrecoverable? When this transaction doesn't occur, when we do not receive the cash, that's when the third entry comes into place. This is when you are writing the debt off. So debit irrecoverable debt expense, credit receivables. Okay. Now, what is the fourth entry? Irrecoverable debt gets recovered. So it gets recovered now. We had already closed the account in the third one, right? We have already closed it over here. But now the irrecoverable debt has been recovered. So what will you do? Which means cash came in. And we are going to again open the account, which is irrecoverable debt expense. So what is irrecoverable debt expense? It is nothing but bad debts. This is the entries. That is it. This is the only thing which is there in the entry chapter. There are 2-3 more journal entries for the allowances, but just keep in mind these are the most important ones, and I hope you got it. Now let's quickly do the question. Celia Jones had receivables of 3655. At the year, she wrote off a debt from Lenny Smith for 699. During the year 2008, she made these many credit sales and received cash from her customers this much. She also received this much from Lenny Smith that had already been written off. What is the final balance in her account? Okay, let's do this. Okay, let's write the final balance of 2007 and 2008 on the receivables account. So let's first do 2007. How many receivables did she have in 2007 initially? She had 3655 initially. Okay, At that rate, she wrote off a debt of 699. So she wrote off 699. Okay. During the year 2008, she made this much. Okay. Let's first finish the 2017 one. What she did. So what was the balance in 2017? This is the balance. 3655. I hope you're solving it along with me. Minus 699. 2956. So 2956 was the answer. So let's see the answer. So either A is the answer or B is the answer. Now let's do 2008. Let's see what 2008 is now. Okay. During the year to 31st December 2008, Celia made a credit sales of this much and received cash from her customers totaling this much. She also received okay. So what was the balance from previous year? It was 2956. From the previous year, this was my receivables balance. Right. Now, so she made a credit sale of 17832. So we are going to add 17832. Now, she received cash from the customers 16936, which means that much receivables will go out. So she received 16936. Okay. She received 699 from Lenny Smith. See, we already closed the account of Lenny Smith, right? But now she received it again. So what are we gonna do in this? We had already closed Lenny's account. What do you mean by closed? Debit irrecoverable debt expense and credit receivables. We have closed it. So now there will be no change in the receivables because the entry does not involve receivables. What is the entry of irrecoverable debts recovered? It is debit cash, credit, irrecoverable debt expense. So we are not going to involve it. So the final answer would be nothing but 2956 plus 17832 minus 16936. 16936, which is 3, 8, 5 and 2. So the answer is A. I hope you understood it. And I hope you're doing it by yourself. Okay. So now let's come to allowance for receivables. So we all know what allowance is. I have explained it in the starting of the video. So there may be some debts included in the accounts where there is some cause of concern but are not yet definitely irrecoverable. So this is something when we are assuming that it will be recovered. It might be recovered. It's not 100% irrecoverable debt case. So in such situations, we open an allowance account. It is prudent to recognize the possible expense of not collecting the debt, but the receivable must maintain in the accounts. An allowance is set up which is a credit balance. So I told you allowance has a credit balance. All the provisions and all of them have a credit balance. Right. Now let's see the journal entry of the same. This is the last topic in the chapter. So what do you understand by creating an allowance? So whenever we are supposed to create an allowance, this is what we are supposed to do. So again, when we talk about the allowances are credit in nature. Why are they credit in nature? That is because allowance is a provision. So provisions are a liability to the business, and so the balance would be credit. Okay. So whenever an allowance is created or we use an allowance for a bad debt, what is the journal entry? Debit irrecoverable debt expense, because it is an expense, so it is debited, and we are going to credit the allowance for receivables. Okay. In case already, let's say there was a bad debt of 80. So we have a bad debt of 80, or we have an irrecoverable debt expense of 80. We need to use the allowance and write it off, let's say. Then it will be debit irrecoverable debt expense, credit allowance 80, 80. Now, if the question says that we already have an allowance of 20 from before, and now we need an allowance for writing off 80 bad debts. how much allowance we have. So is the journal entry going to be debit irrecoverable debt to allowance 80/80? No. Why? We already had 20 allowance. So we need an allowance for 80, but we already have 20. Then what is the balance? 80 minus 20. What is 80 minus 20? 60. So we need 60 only now, right? So this is going to be 60. Only the balance, new allowance will be created only with the balance, because we already had 20 as the balance. Now let's start with the illustration. We'll just roughly do this. Okay. On 31st December 2011, Jake Williams had receivables of 10,000. At that date, Jake estimated that there was an evidence that amount of 300 may not be recovered. So he wanted to make allowance. So he wanted to make an allowance of 300. It is given in the question. So what is the journal entry of creating allowance? We know that allowance are a liability. So credit allowance for receivable or allowance for irrecoverable debt expense. Allowance for irrecoverable debt expense. Right. And okay. So you can also write it as allowance for receivables. Okay. So allowance, give me a second, for receivables, and debit is the bad debts. Debit irrecoverable debt expense. How much? He wanted to create an allowance of 300. So this will be my journal entry. Clear? Now, during 2012, Jake made credit sales on credit totaling 1,100,000 and received cash this much. At 31st December, Jake now considered that there was a doubt regarding the recoverability of amounts totaling 700 which were overdue, which may not be recovered. Okay, so now he wants to increase the allowance to 700. Earlier he had allowance only 300. Now he would want to increase it to 700. So 300 was already there. So how much? By how much do we have to increase the allowance? 4, 5, 6, 7. 400. 700 minus 300 is 400. So it's gonna be 400 now, right? See, irrecoverable debt expense account debit, allowance for receivables account 400. So the second one is again debit irrecoverable debt expense and credit allowance for receivables. How much? By 400, which is the balance. I hope you're doing it along with me. See, I'm not going to explain the ledger accounts because you know it all. Okay. During 2013, Jake made 95,000 sales and collected 96,000. At 31st December, Jake now considered that amounts totaling only 600 required an allowance for being overdue at that date. The allowance for receivables should be adjusted from 700 to 600. So he wants to adjust 100. By 100, he wants to reduce the irrecoverable debts. So how is he going to do that? Think about it. Try doing it yourself. What will that be? You are going to debit it, right? Allowance balance is credit. Now, if you want to reduce it, you're going to debit it. Okay. So it's going to be debit allowance for receivables, credit irrecoverable debt expense by 100. You are reducing it by 100. So whenever you have to reduce anything, you are going to reverse the entry. Okay, we're done almost. Allowance overdue. That's it. We are done with the question. So let's see one more thing. What is the treatment of receivables and allowance in the balance sheet? balance sheet or statement of financial position. What is the treatment of the same? Okay. So under current assets, you have receivables. Right. You have receivables. So these are the total receivables. Okay. So how are you going to show the provision? Provision is a liability. So how are you going to show it? From the receivables, you are going to subtract the allowance. Then you will be left with the net receivables. Keep that in mind. Now you can go and see the statement of financial position. You have current asset receivables less allowance for receivables. This is the net value. Clear? So that's it. Okay, now this is the last question. Let's quickly do that. Okay, John Stamp has an opening balance on 1st Jan 2006. So receivables was 68,000 and his allowance balance is 3,400. So John made credit sales of this much and collected cash this much. Let's do everything slowly. So first we will write the balances. So the balances are given in the question. In the first line, what is there? Balance of receivables is 68,000. And what is the balance of? I hope you are solving it by yourself and then checking it with me. 3,400. That is what is given in the question. Right. So what happens? During the year 31st December 2006, John made a credit sales of this much. Okay. If you have a credit sales, that means your receivables are increasing. Right. So you are going to add plus 354,000. Okay. What else? And collected cash from his receivables 340. If you're collecting cash, that means your receivables are paying you, which means the receivables are reducing. So let's do subtract it. Okay. Moving on. At 31st December 2006, John reviewed his receivables listing and acknowledged that he is unlikely to ever receive debts totaling to 2000. Okay. So he thinks that 2000 is his irrecoverable debt. So what happens whenever irrecoverable debt happens? What is the journal entry? You write it off. When you're writing it off, it's debit irrecoverable expense and credit receivables. So you are closing the receivables. You are reducing the receivables. So you are going to minus 2000 again. That is the entry. Next. In addition, at that date, amounts totaling to 4,000 were overdue and an allowance for receivables was required to cover these amounts. Okay, he needed an allowance of 4,000. How much allowance do we already have? We already have an allowance of 3,400. So how much allowance you need? 4,000 minus 3,400. 600. So you need 600 more allowance. Right. What amount is charged to John's statement of P&L for irrecoverable debt expense in the year 31st December 2006? Okay. Okay. Now let's discuss the journal entries of the same. Okay. So 2000 were declared as irrecoverable debt, right? Here we know the 2000 was declared as irrecoverable debt. So this is our journal entry 2000, 2000, right? Now, when you are creating an allowance, you are creating an allowance of 600, right? So what is the journal entry of that? Credit allowance, because credit balance, debit, irrecoverable debt expense, how much? 600, 600 and 600. Okay, what's the question? What will be the effect irrecoverable debt on the statement of P&L? Okay, so what is the total balance on the side of irrecoverable debt? So here we have 2000 and here irrecoverable debt we have 600. So 2000 plus 600 is your answer. That is what is there in the side of irrecoverable debt expense, 2600. Let's see if it's the answer. C. Okay, let me just quickly check my answer. The answer is C. So I hope you understood. That's it. We are done with the chapters. We just have hardly 3 to 4 journal entries which you are supposed to learn. And once you know the journal entries, the entire chapter is easy. So if you have any doubts, you can put them down in the comment section below. Thank you.